Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Scott Hazlett. Scott is a California attorney and CPA who practices in the areas of taxation, real estate planning, financial problem resolutions, and 1031 exchanges. He is a certified specialist in taxation law by the California Board of Legal Specialization, and he's also a qualified intermediary for tax-deferred exchanges. Scott previously worked with Price Waterhouse and was an investment executive with Merrill Lynch. He graduated from Taft University School of Law in 1996 and set up his own law firm. He is the incoming president for the East Bay chapter of the California Society of CPAs. By the time you see this, he will be the president. Anyway, and in a past life, you might be interested to know that Scott was a sports writer covering Major League Baseball, National Football League, and other sports. Today, Scott and I are going to be talking about tax-deferred or 1031 exchanges of real estate. And before we get started, I want to caution you that this is a complex area of the tax law. We're going to give you an introduction to this area, and this should be the beginning of a conversation with your own tax advisor. Related to this, to let you know, additional information, I have a book that I've written, the Real Estate Tax Handbook, and it has information on 1031 exchanges in there. So with that, Scott, let's get started.
All right, great.
Thanks for being with me today.
Thanks for having me. This is terrific.
Yeah, it's a pleasure. Okay, well, here we are. This is 2010. Today is June 15th. And this has been a gosh-awful period, it seems like, for real estate. So are people actually doing tax-deferred exchanges right now?
You know, it's interesting you mention it because we've had for the last, 19 years. I mean, I got in this business in the late 80s and as exchange intermediary. And we've had kind of a steady diet of exchanges throughout that period. And then in about, I'd say 2003, 2004, things started to accelerate. Of course, after the dot-com boom and bust in the early 2000s, and of course real estate became the hot commodity.
Right.
And this is largely a real estate driven transaction technique to defer exchanges. So as property values grew and taxpayers' zeal for avoiding taxes is always there, of course.
Yes.
Then you're going to end up wanting to, buy and sell property but not pay the tax, and that's what this transaction is all about. That's what the code section is all about.
Right.
So we had tons and tons of exchanges. Now, somebody asked me the question, how's the exchange business? I'm acting as a qualified intermediary and advisor to a lot of investors, real estate agents, other tax professionals, et cetera. I teach the class, as you know, for the Cal CPA Education Foundation on exchanges. Everybody says, well, how many exchanges are you doing these days? And the answer is not too many, but some. The ones we're doing now are a little more complicated, or they're the kind of ones that have a little bit of controversy related to them. And but my sort of common response is that all the gains are gone. And the whole idea of the exchange is that you want to avoid paying tax on gains. And of course, if there are no gains, then you're not exchanging. So the need for my services has diminished to a large degree in recent times.
Right. So an awful lot of people, well, we were talking before, you and I have been doing a lot of consulting for people related to short sales and foreclosures.
Yes. Right. Well,
these people aren't doing exchanges, and
no,
they actually have losses.
Well, exchanges are the last thing you'd want to do, of course, because that would not be the right technique, of course.
Yeah. So you want to match a loss if you've got one related to. Now you may have one deferred gain related to a refi that they did before that you need to watch. But anyway, when you're in that sort of a pickle, it's pretty hard to plan around avoiding it.
Correct.
Okay. Well, and as we said, though, also that there are some people that may have had property for many, many, many years. So my parents bought their home back in 1958 for, I think, roughly about $30,000
Right.
in Saratoga, and now that's $1 million property.
Right, right.
Of course, you can't do it with a residence anyways, we'll talk about, but nonetheless, if you've got commercial properties or rental properties that you've had for many years like that, then you may actually...
Well, two things actually happen. One is, of course, properties may have been purchased long ago when values were lower than the current relatively low values. So there's some gain built in there still.
Yes.
They might have started at 30,000, gone to $1 million, and now they're at 800. So they've still got a tremendous amount of gain in some properties. And the other thing that happens is that over time with investment properties, that 30,000 base or that 50,000 base, that starting point diminishes because, of course, depreciation expense is charged off each year. And so after, under current law, after 27 years, you could be down to just some kind of land base. And so if nothing else, you may not have an economic gain, but you have a tax gain based on a paper transaction that's occurred over those years.
Right. Okay. So now let's get to the real basic. What is a Section 1031 exchange?
Well, it's real interesting that when you look at the tax code generally, an exchange of property, exchange of interest, exchange of stuff is ordinarily considered a taxable event. So, for example, I go into the hardware store and I buy some paint. I give them money. They give me the paint. Well, they probably paid $5 for the paint. They're selling it to me for $15. So they have a gain or they have income,
right.
And that's an exchange. Well, that's taxable. That's just an ordinary type of transaction.
Right.
In 1031, which is a specific code section, is intended to address certain transactions in our common parlance, real estate transactions, where you have a gain from a disposition of property, but where you wish to continue in the progress or in the process of having the investment property or business property by buying another property.
Right.
So, for example, in the common transaction, you might have a sale today of an investment property. This could be a rental home, this could be a commercial property, this could be an office building, land, and then you sell the property, you conduct yourself accordingly, according to tax regulations, of course, we're going to talk about, and then you go out and buy replacement property, perhaps even at a different date, within 180 days generally, and you can avoid the tax on the gain from the sale of the first property and, in a sense, roll over the gain into the next property. So that is an exchange in the tax sense. It's not really an exchange. It's really a sale and a purchase, but we call it an exchange because that's the genesis from the code.
Right. So we used to talk about basically that 1031s would be structured as simultaneous transactions.
Right.
The exchange would happen at the same time. And then there was a decision called the Starker decision,
Right.
Where basically what happened, I think it was Boise Cascade, wasn't it? They held...
That was Crown's all about, correct.
Crown's, well, no, it was one of those big companies like
correct.
that. So Crown's back, they held the cash that they were to pay for this property for many years to get the replacement